Every house on your route thinks they know you. The mail carrier who's been walking this street for 18 years. Nobody on it has any idea what your brokerage account looks like. You make $58,000 a year delivering mail for the postal service. It's a solid job. Nobody's ever called it an impressive one. You drive a 10-year-old hatchback to work. It's paid off. You've never once cross-shopped anything newer. You live in a one-bedroom condo you bought 15 years ago. It's small. It's paid off. You've never felt the pull to upgrade it. At a neighbor's birthday dinner, someone mentions they're worried about retirement. You nod along. You don't mention that you could retire tomorrow if you wanted to. You own no real estate beyond that one small condo. No rental properties. No side business. Every dollar of what you've built came from one place, the stock market. Your total net worth today, $4.1 million, built entirely through a retirement plan, a Roth IRA, and a plain taxable brokerage account over 24 years. You've never told anyone on your route. Most of them would guess you're getting by, same as everyone else on a mail carrier's salary. You started at the Postal Service at 26, right after a retail job that offered no retirement plan at all. The thrift savings plan felt like a foreign language in your first orientation meeting. You contributed 5% that first year, just enough to capture the full agency match. You didn't understand compounding yet. You just understood free money. You put it entirely into the C fund, the TSP's version of an S&P 500 index. A co-worker told you it was the safe, boring one. That description turned out to be the best financial advice you ever received by accident. The dot-com crash hit 2 years later. Your balance, small as it was, dropped nearly 40% over 18 months. You didn't sell. You didn't fully understand what was happening well enough to panic. By year 5, you increased your contribution to 10% after a modest raise. You opened a Roth IRA the same year, funding it with tax refunds you used to spend on things you don't remember anymore. The 2008 financial crisis hit when you were 35. Your combined balance fell by more than half in less than a year. This time you understood exactly what was happening, and it terrified you anyway. A coworker cashed out his entire TSP balance that year, converting the loss into something permanent. You watched him do it, and kept contributing anyway, mostly out of stubbornness rather than confidence. By year 15, you'd increased your contribution to 15% and opened a taxable brokerage account for money beyond what the retirement accounts could hold each year. The COVID crash hit in 2020. Markets fell over 30% in 5 weeks, faster than anything you'd lived through before. You increased your contribution that same month instead of pulling back. By 2022, a slower, grinding bear market tested a different kind of patience than a sudden crash does. No panic, just months of a balance that quietly went nowhere. You barely checked the account that year. Somewhere around year 10, a financial planner at a free workplace seminar suggested you were too conservative for your age, holding too much in a single index fund instead of diversifying into individual sector picks. You went home, compared the seminar's suggested portfolio to your own actual returns over the previous 5 years, and decided the free advice wasn't worth what it would have cost you in fees and complexity. By year 20, your annual TSP contribution reached the full legal maximum for the first time, made possible by 2 decades of automatic percentage increases you'd nearly forgotten you'd set up in the first place. Here's what a postal uniform and a paid-off hatchback don't show you. Your thrift savings plan balance today, $2.3 million, built from contributions that never once exceeded 15% of a modest government salary. Your Roth IRA, maxed every single year it was available to you since you opened it, sits at $890,000. None of that growth will ever be taxed again. Your taxable brokerage account, funded with whatever was left over after maxing the tax-advantaged accounts, holds $920,000, almost entirely in a total market index fund. Add it up, and you're at $4.1 million. You've calculated the exact figure exactly twice, both times for your accountant. Your dividend income alone, money the portfolio generates automatically every quarter without you selling a single share, now exceeds your annual postal salary. You've never owned an individual stock beyond a small, deliberately limited position you allow yourself for curiosity, capped at 3% of the total portfolio so a bad pick could never actually hurt you. You've never used a financial advisor. Every decision across 24 years came from books, a handful of trustworthy websites, and a genuine willingness to do nothing when doing nothing was the correct move. Your expense ratio across every fund you hold averages 0.04%. You've never paid an advisory fee, a load fee, or a commission on a single trade in over 2 decades. That single decision, avoiding fees most people never notice they're paying, is quietly worth hundreds of thousands of dollars across a portfolio this size over this many years. You've never had a mortgage larger than your condo required, no auto loan, no credit card balance carried past a single billing cycle in over 2 decades. The absence of debt payments freed up more monthly cash flow for investing than most raises ever could have, a detail that never shows up in any conversation about how someone got lucky with the market. Your effective tax rate, thanks to decades of Roth contributions and careful asset location, sits noticeably lower than several coworkers who earn less than you but hold everything in taxable accounts without thinking about it. You've calculated that your portfolio, left completely untouched and simply left to compound, would likely double again within roughly 9 to 10 years even without another single dollar of new contribution. That fact alone changes how you think about your remaining working years entirely. The job is no longer funding your future, it's simply funding your present while the future quietly funds itself. Your sister, who works in corporate sales and earns nearly triple your salary, has less than a fifth of what you've saved. She's mentioned it herself, more than once, with a mix of pride in you and quiet frustration at herself. The dot-com crash wasn't the scariest part. The scariest part was year 3 of that crash, when the balance still hadn't recovered and a coworker asked if you regretted wasting money on it. You didn't have a confident answer. You just kept contributing, because stopping felt like it would make the loss permanent in a way that continuing somehow didn't. In 2008, you watched your neighbor lose his house entirely, a completely different kind of financial disaster than what was happening in your own account. And it made your own losses feel almost embarrassing to worry about by comparison. You didn't touch your accounts that year beyond the automatic contributions. You also didn't feel good about it. Doing the right thing and feeling good about it turned out to be 2 completely separate experiences. A cousin lost nearly everything trying to time the 2008 recovery, selling near the bottom in fear and buying back in near a temporary peak 18 months later, locking in the worst possible version of both decisions. You never once tried to time anything. Every contribution landed on the same day of every month, mark it up or mark it down, for 24 straight years. The COVID crash in March of 2020 was the fastest, sharpest drop you'd ever lived through, over 30% in barely a month, while the news made it sound like the entire economy might not recover at all. You genuinely didn't know, in that moment, whether the recovery would take months or a full decade. You increased your contribution anyway, because the fear of missing a rebound had finally started to outweigh the fear of a further drop. The market recovered within 5 months, faster than any crash in your lifetime. Nobody could have predicted that timeline in advance, including you. The 2022 bear market tested something entirely different. Not fear, boredom. A slow 13-month grind where the balance quietly went nowhere, and there was no dramatic headline to explain why. You checked the account maybe 4 times that entire year. Not out of discipline exactly, out of a genuine loss of curiosity about a number that refused to do anything interesting. That indifference, it turns out, may have been the single most valuable emotional skill in the entire 24-year stretch. Across 4 separate crashes and 1 long grinding bear market, you sold exactly 0 shares out of fear. Every single dollar that ever left those accounts left through a planned withdrawal decades later, not a panicked one in the moment. During the dot-com crash, a specific headline stuck with you for years. A major fund manager publicly declaring the old rules of investing no longer applied. He was managing a technology fund that lost 80% of its value within 2 years of saying it. You never chased that fund or anything like it. The boring index you'd been told was the safe one had no opinion about new rules. It just held the same 500 companies it always had. In 2008, your own bank, the one holding your checking account, nearly failed during the same month your portfolio dropped by half. For about 2 weeks, You weren't entirely sure your direct deposit would even clear. It did clear every single time. The fear that year had very little to do with the actual math, and almost everything to do with how uncertain everything else around the math felt at the same time. A close friend, working in a different industry entirely, was laid off in early 2009 and spent 11 months searching for comparable work. You kept your job through the entire crisis. Job security turned out to be its own quiet form of wealth that never showed up in any account balance. During the COVID crash, your own postal route became essential work overnight, busier than it had ever been, delivering medication and groceries to neighbors who couldn't leave their homes. You increased your investment contribution during the same month your job got physically harder and more exhausting than it had ever been. Both things were true. Neither one made the other easier. The 2022 bear market coincided with the highest inflation you'd experienced in your adult life. Groceries cost noticeably more every single month while your portfolio simultaneously refused to grow. It was the first year both problems hit at once. You didn't reduce your contribution to cover the higher grocery bills. You adjusted smaller things instead, the same kind of quiet substitution that's shown up in every one of these stories. Fewer takeout dinners, a canceled streaming service, nothing dramatic. A cousin who worked in real estate development was hit especially hard by the 2022 rate increases, watching 2 projects stall out entirely. Every asset class has a year that tests it. Yours just happened to be a quiet, boring one instead of a dramatic collapse. Looking back across all 4 events now, the pattern is almost embarrassingly simple. The crashes that felt the most different from each other in the moment produced the exact same correct response every single time: nothing. A homeowner on your route, retired and comfortable, once offered you a small tip for the holidays, assuming a mail carrier's salary probably needed the extra help. You accepted it graciously. It felt rude not to, even though the actual dollar amount was smaller than a single day's dividend income from your brokerage account. At a union meeting about pension negotiations, a younger coworker assumes you're anxious about retirement security the same way most people your age in this job are. You're not anxious. The pension, whatever it ends up being, was never actually part of your real plan. You just let people assume it was, because correcting it would require an entirely different conversation. A financial advisor who cold calls the house pitches a basic starter retirement plan for people just beginning to think seriously about their future. You let her finish the entire pitch before declining. A younger coworker asks for advice about opening his first retirement account. You explain the TSP match, the index fund option, and stop there. You don't mention your own balance. He never asks. At the grocery store, a cashier makes a passing joke about mail carriers being underpaid. You laugh along. It's easier than explaining that the joke happens to describe your salary, but not your net worth. Your landlord, back when you rented before buying the condo, once offered you a payment plan for a security deposit, assuming a postal salary might make the lump sum difficult. You paid it in full. The landlord paused half a second before writing the receipt, the same small pause you've noticed in a few other people over the years. A doctor's office biller once offered to set up a payment plan for a bill you'd already intended to pay in full that same visit, assuming a postal salary probably made the full amount difficult. A car mechanic quoting a transmission repair assumed you'd want to explore financing options before you'd even asked about the total cost. At a union holiday party, a coworker's spouse asked, gently, if postal work came with decent enough benefits to actually retire on. You said it was manageable. That answer wasn't quite the whole truth. A new supervisor, reviewing route assignments, assumed you'd want the overtime-heavy holiday shifts most carriers request for the extra income. You declined, and he seemed genuinely confused by that. None of these assumptions are unreasonable. They're simply built from the only information anyone actually has access to: a uniform, a route, and a publicly known salary range for the job. None of these people are wrong to assume what they assume. A postal uniform has never once implied a $4.1 million portfolio to anyone. The gap isn't between who you pretend to be and who you are. It's between what a government salary is supposed to predict and what 24 years of automatic, boring contribution actually built underneath it. Around year 12, you learned about asset location, The idea that which account holds which investment matters almost as much as what you actually invest in. You moved your bond-like holdings into the tax-deferred TSP and kept the stock index funds in the Roth and taxable accounts, letting the highest growth assets sit where the growth would never be taxed. That single adjustment, made in a single afternoon, is quietly worth tens of thousands of dollars in avoided taxes across the following decade. You started tax loss harvesting in your taxable account during the 2022 bear market, selling small underwater positions to offset gains elsewhere, then immediately buying a similar but not identical fund to stay invested. That single bear market year of harvesting losses saved roughly $4,200 on your tax bill the following spring, turning a discouraging year into something quietly useful. You rebalance your portfolio exactly once a year, every January, using new contributions to correct any drift rather than selling anything and triggering unnecessary taxes. You've never chased a hot sector, a trending stock, or a piece of investing advice from social media. The boring index approach has quietly outperformed every alternative you've ever seriously considered. Around year 20, you set up a mega backdoor Roth conversion strategy through an after-tax contribution option in your plan, squeezing additional tax-free growth space beyond the standard limits. It required reading the plan document twice and calling the benefits office 3 separate times to confirm it was actually allowed. Almost nobody at your workplace has ever used it. That single strategy alone added an estimated $61,000 in additional tax-free growth space over the 4 years since you started using it. None of this required a financial degree. It required reading, patience, and a willingness to spend a few afternoons a year on something most people never think about, beyond checking a box once and forgetting it. You opened a health savings account when your postal insurance plan qualified for one, around year 16. Almost nobody in your union talks about it as an investment account rather than a medical spending card. You paid small medical expenses out of pocket instead of from the HSA, keeping the receipts in a folder, and let the account itself invest in the same index fund as everything else. It's the only account with 3 separate tax advantages, and you use all 3. That account now holds $94,000, quietly growing tax-free for medical expenses you may not need to reimburse yourself for another 20 years. Around year 18, you started thinking seriously about sequence of returns risk. The idea that the specific years right before and after you stop working matter more than almost any other years in the entire timeline. You began keeping 2 years of planned living expenses in a separate cash-equivalent fund specifically so a bad market year right after retirement wouldn't force you to sell shares at the worst possible time. You've also purchased I-bonds during periods of high inflation, a low-drama way to protect a small portion of savings without taking on any additional market risk. None of these decisions individually feel significant. Combined across 2 decades, they represent the difference between a portfolio that merely grew and one that grew efficiently, without unnecessary tax drag or unnecessary risk, at exactly the wrong moment. You watched a coworker mention his modest $401k balance at a union barbecue once, a number smaller than yours by a factor of 10, and get treated differently by half the people there for the rest of the afternoon. Money changes a room the moment it's spoken aloud, even in small amounts. You've never needed to test what a number 10 times larger would do to a room like that. Your ex-wife knew the real number. It was never hidden between the two of you, even after the divorce 5 years ago. He's the only person outside your accountant who's ever seen the full picture. Your adult son knows you're good with money. He doesn't know the exact figure. That's been a deliberate choice, not an oversight. The same way it was for the landlord in a similar story a few videos ago. You'll tell him eventually, not the number first. The 24 years of not selling during 4 separate crashes first. The number only makes sense once someone understands what it actually cost in patience to build. Here's the actual pattern worth noticing. Whether your salary is $58,000 or $158,000. The wealth was never in picking the right stock. It was in never selling the right fund during the wrong week. 4 separate crashes tried to talk you out of this strategy over 24 years. Each one felt, in the moment, like it might be the exception that proved staying invested was foolish. None of them were the exception. The mechanism that actually built $4.1 million wasn't a secret strategy. It was automatic contribution, low fees, and enough boredom to ignore the noise for 2.5 decades. Tomorrow you'll deliver mail to the same houses, in the same uniform, on the same route. Nobody will know the number. That was never really the point of building it.